How can you get money by selling part of your business? Well, it's actually called equity financing, and it's one of the easiest ways to get money, especially for startup businesses, and a way to get tremendous amounts of funds to be able to grow your business to be very successful. And today, I'm going to teach you everything you need to know to be able to actually get money from investors, whether it be angel investors, venture capitalists, even equity crowdfunding. There's so many unique ways to do this. I'm going to break it all down for you, and by the end of this training, you're going to understand like a lot of different ways that you can actually tap in, sell stock or exchange stock or a little bit of ownership in your business for the money you need so you don't have to actually take on debt. So let's jump in. So part of this training, I want to talk to you a little bit about fundability as well, because fundability and setting your business up the right way is not just about being able to qualify for debt financing like it comes to loans and credit lines and credit cards, but it's also equally as important to attracting the right investors into your business as well. So when we talk about fundability, and I will mention some things like choosing the right industry code as we get later into the training, I'm talking about basically the perception of what lenders, credit issuers, and other investors see about your business. It's what makes you lendable. Okay, and I oftentimes talk about fundability as a secret code that lenders and credit issuers use. And if you meet the requirements, you can get approved. And that's great when it comes to borrowing money, like through debt, when it comes to loans, credit lines, or credit cards. But it's also equally important to being able to set yourself up as a legitimate, credible entity and business in the eye of potential investors, angel investors, venture capitalists, and others who might want to invest in your business as well. This is why fundability is so important. So first of all, let's talk a little bit about the basic ways to get money for your business. I call this the 3 C's cash acquisition formula. It really comes down to 3 main ways. Typically, if you want to borrow money and take on debt, and by debt, I mean you get a credit card, you get a loan, you get a credit line. It's money that you're borrowing from a banking institution, typically some kind of lender, some kind of private investor that's lending you money, and it has to be paid back on some kind of terms. Okay, here's a credit line, you pay 6% interest rate on the credit line. Here's a loan, you pay 7% over 10 years. It's being lent money, and you're paying the lending institution interest fees on that money. That's how they get paid. Well, typically, there's 3 ways to qualify for financing. It's whether you have cash flow in your business, bank statements, tax returns, having that can open up funding options for you. Having good credit, business or personal credit, that opens up funding options for you as well. You could build your business credit, get credit cards. You could use personal credit to get credit lines and credit cards and loans as a startup as well. Or the 3rd C is collateral, some kind of asset that's actually serving up as collateral that you can actually use to as a startup or an existing business where you could borrow money using that asset that serves as collateral and get a low interest rate loan or line of credit. So that's a 3 C's formula. Now, keep in mind that there's a whole other way to get money as well. What I just showed you and talked to you about was really about debt financing, where you're taking on debt, where you're taking on a loan or a credit line or a credit card with set terms to a lending institution of where it needs to be paid back. There's a whole other side of this equation. And the whole other side of the equation is called equity financing. It's different than debt financing, because when we look at the equity financing, what you're typically doing is giving up or exchanging part of the ownership in your business for the money that you need. Okay, so you're typically giving somebody else access to ownership, stock, whatever you may be, in exchange for the money that you're getting from them. But the nice thing is you don't take on debt. You don't have to have good credit. You don't have to have cash flow. You don't have to have collateral to get equity financing. And the money doesn't have to be paid back. It's not like you're paying back money on terms. So it works very good in startup situations, especially because you don't have to pay that money back. That investor typically is earning their money whenever you go to an exit, such as selling the business, such as going public, whatever your exit event is. So when we look at equity financing, the first thing we want to talk about is angel investing. There's a few stages that your business may be in. Angel investing is the beginning stage. This is where investors want to give you money because you have a really good idea, a really good concept, and get that concept off the ground. Okay. As a matter of fact, I was listening to a podcast on one of Roland Fraser's podcasts the other day, and there was an angel investor on there just this morning. And it was interesting because he was talking about, and I'm not saying the angel investor was on this morning's podcast, but it was the podcast I listened to this morning. So he talked about Uber, for example, and the initial angel investors in that put $25,000 into Uber initially, the first angel investors. That $25,000 was worth $60 million. Okay. So this is why angel investors do what angel investors do, because when they hit home runs, they hit home runs. And that gives you an idea of why this whole class of money exists. Because if you could put in 25 grand and walk away with $60 million, that's why angel investors invest in startups. And again, Facebook and all of these large publicly owned companies, or even the privately owned companies, all started off with similar stories. So angel investing is probably the easiest way to get started, because typically what happens is you're dealing with angels that are giving very small amounts of money. 5 grand, 10 grand, 15, 20, 25. Rarely, typically, does it surpass 50 grand. Now, there's all kinds of deals where angel investors are putting in way more than that, but oftentimes, angel investors are putting in a bunch of cash, less than 50 grand. And as a result, they don't want a bunch of control in the business. They don't need a seat at the table and be a board of directors. They don't need to control the decisions you're making in the company. They don't typically expect to get 50, 60, 70% of controlling stake ownership in your business. That's why it's some of the easiest type of equity and financing to get. Now, angel investors invest in small startups and entrepreneurs, and often they're among an entrepreneur's family and friends. And yes, your mom can be an angel investor. So let's talk about there's two types of angel investors. There's what's called an affiliated angel, and there's what's called an unaffiliated angel. Now, affiliated angel investors are affiliated with you. They are your mom. They are your dad. They are your friends. They are potential investors. They are managers at the business that you're leaving. They are colleagues. They are people that know you, believe in you, like your idea, like your concept, or like you, and they decide they want to put some money in to support that for you to get the business off the ground. A lot of people think about angel investors as unaffiliated angels, people that are just floating around in Silicon Valley that they're going to go do a pitch deck for and get money. Yeah, they're out there. Okay. Those are called unaffiliated angels. But here's what's interesting. In order to get unaffiliated angels, you almost always have to have angel investors that are affiliated angels already signed up. Okay. And it was funny because when I was listening to this podcast this morning, it's exactly what they said. He said, well, let's do a mock investment thing. I'm the person that wants the investment. You're the investor. I want to hear the questions that you'd ask me. And so one of the questions he asked was, okay, well, who else is invested? And when, Roland, playing the part of somebody that needs money, says, well, I don't have any investors yet. Then he told Roland, he said, look, this is where I would be out. I'm always out of a deal where somebody else isn't in first. It's the one way to lose is being the first dude in. And so this is interesting. This is how angel investors think. They typically don't want to be the first one in. They want to know other people are in. And usually the first people to bring in are the people in your immediate network, even if it's for very small amounts of money. And we'll talk about Kiva later today. And Kiva is interesting because they'll give you $10,000 loan for 0% interest if you have 5 other people around you invest as little as $25 into the deal. So their entire model is built on you having your support network at least having a very small part, $25, right? But they have to have at least a handful of people that are willing to do that, because before Kiva will give you $10,000 at 0%. The idea here is this: if no one around you knows, likes, and trusts you enough to invest in you, why the heck would someone that doesn't know you invest in you? This is the way a lot of angel investors look at it. So you always want to start with your immediate network. And again, I'd like to say that it's not about asking people around you for money, hitting mom and dad up for money, hitting your friends up for money. I don't like that. I'm sure you don't like that either. It's the last thing we want to do. But it's about giving them the opportunity, okay? So my family and friends, if I let them in at Credit Suite in the very beginning and they're exchanging money, that money is going to be worth a lot of money to them. They're putting in hundreds or thousands of dollars that equate to hundreds of thousands or millions upon exit. So if you really believe in yourself and what you're doing, then you might want to tap into your existing network first, because your existing network or affiliated angel investors around you, once they're in, they can get a huge rate of return when you sell or exit the business down the road. And they're the first step to getting the unaffiliated angels, the people you don't know, to invest in your business as well. So if I go to an angel investor, they say, who else is in? I say, look, you're the first investor I've talked to. But so far, my mom and dad have invested. I've got 3 friends that are invested as well. I've got 2 other guys that I work with. And I mentioned 5, 6, 7, 8 people. That angel investor, what they hear is, okay, so you've got a lot of people around you that know in you and believe in enough in you to put their own personal money behind you. That goes a long way to an unaffiliated angel stepping up. And Tanya, hello from Raleigh. Hey, I just bought a car from Raleigh. So we're like brother and sister now. Andre says, hello from South Carolina. Quentin says, hi, hope all is well. It definitely is. Joe's not here, but Joe, I will make sure that you actually get a recording because it's on YouTube. So the capital angels provide is a one-time investment to help the business get off the ground. So angel investment comes in almost always before you're generating revenue and profit, and typically before you even have a product created. Or it can be ongoing injection of money or support carried to the company. It's usually not ongoing. It's usually one amount of money, and then you might have to go back to that angel investor for future money as the business continues to grow. So angels are not covered by the SEC standards for accredited investors. And accredited investor standards, I think, is you need to make $250,000 a year in income or have $1 million in net assets for the SEC to give you an accreditation as an investor. So angel investors don't have to be accredited. This is why you can go to mom and dad and family member and friends. They don't have to have $250,000 in income or $1 million net in order to qualify to be an actual accredited investor. So since anybody can invest, then it's way easier pool or bigger pool of people to tap into to actually get money. Now, if you're getting value, do me a favor, hit the like button, hit the love button. If you're really getting value, then hit the share button. That's the only thing I ask you during the training, but I definitely ask you for that because the more people that like and love this, then what happens is the social networks just show it to more people, and it gives us together a chance to help as many entrepreneurs as we can. So it's usually, it can be rather informal arrangement as the government does not get involved. So much easier than dealing with accredited investors. Now, angels, as we mentioned, they could be home, they could be friends, they could be tapping into their own stocks and bonds, they could be tapping into their own home equity, local professionals who might want to invest people around you. So you got to really look for people in your immediate network that may want to actually invest. And remember, they don't need to invest cash. There's 401k, IRA, stocks, bond financing where they could leverage stocks, bonds, 401ks, IRAs to get financed. They could still earn the interest on the stocks and bonds they have and give you access to some of those funds. They still earn interest, and you could use the funds to help get the business off the ground, for example. There's other assets they could pledge as collateral to get financing, as well as tapping into cash. There's a lot of different ways they can invest in you in the business. So angels are informal investors, so there aren't really terms that they must meet. Technically, there's nothing done for qualifying, okay, although investors may insist on a valuation of your business. So it may be common, or they may want to try to figure, they're going to try to figure out how much they're going to put in and how much equity they want out just by kind of trying to determine what amount of equity they want to take. Okay, and that's typically what they're going to look at. Is they're going to do some kind of valuation. They'll look at your business, get an idea of what it's worth, and then get an idea of how much money they're willing to give you and how much ownership interest or stock that they want in exchange for that. Okay, business revenue financing. Now, I talk about this even though this isn't really equity investing, but it is kind of a way of selling future revenue to get financing. So it's something I want to at least tap into on this topic because it is another way that you can actually get money for your business. Now, it's a way to be able to get money from potential investors, sometimes even private lenders, where you're just selling some of your future revenue at a discounted rate. And a lot of people think cash flow financing, revenue lending, revenue financing, it's a loan. It's not a loan. Actually, what you're doing is you're taking the fact that you've generated consistent revenue and selling it to an investor for a discounted rate on that future revenue. That's how that actually works. Typically, you can get as much as 15% or sometimes upwards of 20% of whatever annual revenue may be. You are able to get funded in 24, 48, 72 hours. You can get approved with no collateral with bad credit. So something that you want to consider there as well. And again, you know, how much, whether you pay weekly, daily, monthly, kind of depends on your risk. Now, equity crowdfunding is something fairly new, and it's basically a stock offering from a company that's not listed in the stock exchange. So what happens with equity crowdfunding, this is fairly new because of some recent changes. And what's happened is that when we think about buying in the stock market, we're basically investing money into publicly owned companies. Now what's happened is this newest trend in business lending over the last 7 years has been that now individuals can invest into privately owned companies, much like they could in publicly owned companies. And look, a lot of people are sick and tired of the stock market. So this gives a lot of people with money and investors options to be able to invest in more companies, hundreds of thousands of more companies, millions of more companies, because there's a lot of small businesses that are not on the stock exchange, but equity crowdfunding gives us the opportunity to actually come in and to be able to invest into privately owned companies. So equity crowdfunding has been around for less than 10 years. Like I said, really become popular in the last 7. It's not the same as rewards-based crowdfunding. So when we think about rewards-based crowdfunding, we think about Kick Further, we think about Indiegogo, And the reason they're called rewards-based crowdfunding is that you put a campaign up on Kickstarter and you say, okay, I'm trying to raise money to, sell pins or create this really special pin that does something cool. Well, then what happens is then you raise money from a crowd, and then there's some kind of reward or bonus they get. Now, the reward is if they give $100, they already automatically pre-order the pin. It could be that if they, donate $50, they get X, whatever X may be. So there's rewards you're giving them in exchange for you giving them the actual money. That's not what equity crowdfunding is. Equity crowdfunding is a way where you're basically coming in and instead of going to individual angel investors and doing a pitch deck, each single one, now you're using an equity crowdfunding platform where you could put your pitch in one place, all these angel investors see it, and they can contribute smaller amounts of money, but that smaller amounts of money pools together to be one larger sum. So an example is, you're trying to raise 50 grand. Through equity crowdfunding, you got 5 investors that put in 10 grand. And together, that's pulled together to give you the 50 grand. And they're using a platform like Crowdfunder to be able to do that. So it's essentially a different way to sell shares, which means you're selling off part of the business. And I don't like the term selling off part of the business. You're basically exchanging equity for money. You're basically selling stock for money. Okay. And you have to keep in mind when people think about that, they think of that as a bad thing. Guys, the person that painted Facebook's initial office walked away a multimillionaire because Zuckerberg paid him with equity in Facebook. Okay. So if some people try to hold on to their equity and not give away any money, and it's interesting because I'm just listening to Grant Cardone's 10X seminar. And a lot of times several people had mentioned the same thing. They think it's a bad idea for you to even have 100% ownership in your business because you don't have anybody's outside perspective in there. Okay. So what happens is that when you're coming in with equity crowdfunding or when you're coming in and exchanging equity, you're basically giving or selling part of the stock in your business for that. Every one of the largest publicly owned companies out there has done it. Okay. Hugh Hefner started Playboy by borrowing money from his mom. Okay. So I can give you story after story after story. And that's exactly the same with Jeff Bezos with Amazon. This is how he got money initially. And like I said, a perfect example is that Facebook, to get their office painted, gave up equity because they didn't have the money to pay anybody. Okay, so a lot of companies have gotten where they are by using their equity to be able to buy their way up until they had the money to pay. Okay, so potential investors visit a funding portal website with equity crowdfunding. They explore different options, and there are limits on how much capital an individual can invest on there, but these limits are based on their income and net worth, and equity crowdfunding gives investors basically a stake in your business. So you can look at Crowdfunder. Crowdfunder is the biggest in the equity crowdfunding space, but you should know, there's equity crowdfunding for real estate investors. So if you're a real estate investor, there's specified crowdfunding platforms out there, equity crowdfunding platforms out there specifically for real estate investors. But again, Crowdfunder is the biggest in the equity crowdfunding space. Remember, they're just the platform. Crowdfunder's in the middle, same as Indiegogo and Kickstarter, and they link together the backers, the people with the money, to you, the borrower. So borrowers and backers, and in the middle is Crowdfunder. They're the equity crowdfunding funding company. So the Securities Act of 1933, this is how equity crowdfunding is now possible. Regulation crowdfunding, 17 CFR Part 227, Regulation D rule. I'm not going to read all this, but you should take a screenshot if you'd like to know why all of a sudden equity crowdfunding and all of this has become so popular over the last 7 years. These are the regulations. You can see that these regulations have come out to make it where equity crowdfunding can exist. This is why we now have this beautiful resource to tap into to be able to get money. And Nashada says, great info. Thanks for tuning in. I appreciate it. Angela, I'm all in on my friends. Happy VIP. Thanks for creating Credit Suite. Thank you. And Luis, you're awesome. I appreciate it. And everybody, thank you very much for coming into the stream. And now I am answering you. Credit Suite is on my Facebook page answering you. So whoever that is at Credit Suite, thank you very much for that as well. Okay, so federal law can be complex. It's best practice to consult with an attorney well-versed in federal law, specifically securities and corporations when it comes to interpreting qualifications. But again, pretty simple. If you're using a platform like Equity Crowdfunder, a lot of that's already done for you. So now let's talk a little bit more about venture capital. Now, this is when you really have something that could be disruptive, right? We hear that term all the time. So venture capital, we've talked about angel investing. We've talked about equity crowdfunding, a lot of the places where a lot of the initial angels sit, where they give you the initial money to get something off the ground. Now, let's say you got the concept off the ground. You created the product. You're actually making sales. Maybe you're actually creating profits. This is usually where venture capital comes into. Not always, okay? When we look at Ubers of the world, when we look at Facebook of the world, they brought venture capital in before they ever started producing money, but they were going in a mass user play, right? So they were all trying to get massive amounts of people using them, and then they went and started making money to figure out that later. So there are definitely plenty of examples that are pre-revenue before anybody's really making money, where their venture capitalists are coming in. And like I said, Uber and Facebook, these are perfect examples of really high level, very high-end venture capitalists coming in with a lot of money, millions of dollars, because they were accumulating so many users so quickly. But typically with venture capital, you don't usually get into this stuff until you've already got a concept, you got a product or service, you're generating revenues, you're generating profit. You can go out and show that you're actually building a business, and it's already being well received. People like it, people are buying it, it's scaling. So this oftentimes works good if you are really creating a disruptive industry. If you're doing something that's never been done, if there's a clear standout between you and your competition, if you're creating a product or service that could completely change the world, Airbnb, Uber, okay, Facebook, for example, all these companies, even Clubhouse now. Clubhouse just came out as, I think, a $1 billion valuation as the newest social media network. So again, but they're accumulating users very fast, and the usage and all their statistics are what's going to help them raise the money. Okay, so venture capital might be a way to go if you have a really unique product, a really unique service, or something very disruptive to your industry. Venture capitalists give money to help build even beyond the startup phase. And again, they're looking for very high growth, very high risk potential. So this is very interesting. When we look at debt financing, when we look at going to get money from a bank, from a credit line, for a loan, for a credit card, they're conservative with their risk, right? They don't want to be too risky with their lending. When we come to getting equity financing, when we come to angel investors and venture capitalists, it's exactly the opposite. They want high risk, high reward situations. They want things that, man, if this thing works, it's going to be like gangbusters. It could potentially be $1 billion industry, a unicorn, right? But they also know that majority of those are going to be duds. And that's what investors will tell you. When you listen to angel investors, they will tell you that 3 or 4 out of 5 of their investments are probably going to fail. But the one that they hit a home run on is so lucrative that it offsets the actual expense of the 3 to 4 that fail of 5. So they're looking for very high risk, very high growth potential opportunities. So they're looking for some unique product, a unique service. You're disrupting your industry, something that's different, that really sets you aside from competition, something that's high risk, something that's very high reward for them. Now, often they want to get out in 3 to 5 years. They want to see if some kind of exit plan to sell the business, get rid of the business in 3 to 5 years, because that's when they want. Okay, that's how they get paid. They get paid when you exit. Remember, they don't get paid along the way. They get paid when you exit, when you file and go IPO, when you exit the business, when you get acquired. That's how they get paid. Now, they often are going to want a larger stake of the business. These guys are putting hundreds of thousands and millions of dollars, tens of millions of dollars in. Okay, and as a result of that, they sometimes want a controlling stake. They want more than 50% ownership. They don't, like angel investors, they don't want 5% or 10 or 15 or 25% of the business. They often want 30, 40, 50, 60% of the business. So if we look, for example, at Shark Tank, we sometimes see sharks come in and buy the entire company from somebody. They want 51% because they demand controlling stake of the business. Okay, so these guys are typically wanting more money. They want a game-changing business. So straightforward businesses typically don't work. Venture capitalists are going to invest in real estate investors because how many real estate investors are out there, right? They want something that's unique, different, disruptive, something that really could possibly be world-changing, something that makes them 10, 15, 20, 30, 100x off their investment. And again, I gave that example of when we talked about, somebody coming in and putting $25,000 in initially on Uber and it being worth $60 million. That's what venture capitalists are, but at a much higher level. They want to put in hundreds or even millions of dollars. So venture capitalists often want a large share of the business, much larger than typically angel investors do. And again, they are more formal investors. In order to get in this space, they are accredited. They do have $250,000 in annual income net worth. There are SEC requirements as well that they have to adhere to. Okay, so again, if you're going to deal with a venture capitalist, you probably should have an attorney involved to be able to help you along the way. It's very important. So let me teach you something, a little trick I've learned to attract venture capitalists. Very important trick, because there's two worlds. You can go find angel investors and venture capitalists and beat down their door and ask them for money. You can absolutely do that. Or you can get them to come to you. Let me tell you a way I indirectly and accidentally found a way to get them to bang down our door and come to us. And this happens, I mean, 2 to 5 times a week with venture capitalists that want to give us millions and tens of millions of dollars. Okay. So how do I do that? Well, I do it because there are a lot of publications you could be featured in things like the Inc. 5000. So if we look at the Inc. 5000, the Inc. 5000 is the 5,000 fastest growing companies in the country per Inc. magazine. There's the Fortune 500, there's the Fortune 5000, there's the fastest growing, there's the best places to work. There's all kinds of rewards. I have a team that's put together all these different types of rewards that are out there. You've seen them before, right? And I'm not talking about the cheap ones you spend $2,500 on and they put you in a feature in a magazine and then you can promote it as credibility. I'm talking about the real stuff, the stuff from Inc., the stuff from Forbes, the stuff from Entrepreneur. Entrepreneur had an Entrepreneur 365 contest, and it's the most entrepreneurial companies in the country. But here's what's interesting about these contests. You have to apply. Okay, so people look at the Inc. 5000 and say it's the 5,000 fastest growing companies in the country. That's not true. It's complete BS. Those are the 5,000 people that submitted all the stuff the Inc. asked them for to be reviewed. Okay, we weren't on the Inc. 5000 for much of the time of the history of our company, even though we were growing fast enough to easily be in the top 1,000 or 2,000 companies on there, because we never submitted financials to them. So you've got to have companies, you have to actually choose to apply for these. So it's a good idea to find these contests, Inc. 5000, Fortune 500, Fortune 5000, best places to work, a most entrepreneurial company with Entrepreneur Magazine. Look at all these contests that these companies have and then submit the stuff to them. If you can meet the requirements, submit it to them and apply. You'd be surprised at how many of these things you can win, because not a lot of people are submitting all the stuff and actually applying. Once you're on those lists, they will hunt you out. Venture capitalists will hunt you down. That is their go-to list to get companies to solicit. I didn't know that, but now I do, because ever since we started applying and getting into these publications, then what happens is these guys beat down our door on a consistent, regular basis. It just happens all the time. Okay. And so that's a shortcut, a hack. And I'll even see if I can pull up an example here. So that's a shortcut or a hack where if you want angel investors coming to you, then this is really what you want to do. You want to come in, you want to basically get into some of these publications. Really, most of them have very small, if any, cost at all. And what happens is once you do so, then you're going to actually start seeing that there's a lot of places out there that are trying to actually raise money. And I want to give some example here, at least a couple examples, just so you can kind of see what this is like. Okay, so here is a company that's just an example. These are the type of emails that I get on a pretty regular basis. Hey, our client, a buyer that has completed $19 billion in transactions, is looking to invest and or acquire in a business, product, and service sector. So this is just all about them and the fact that they're interested in actually putting money in. They're actually interested in trying to acquire or to invest initially. Okay. Here's another one of these, and I can just go over these again and again and again. I mean, you can see these are very recent ones. I'm pretty sure these are. This was from, say, 2000. This was the end of last year. This one was from February. So I represent a private equity group looking to acquire or take, companies in Florida. The group operates a $500 million fund, whatever it may be. So this is what happens if you want to start getting these kind of solicitations. And I could, again, show you email after email after email, because they just keep coming. And they keep coming because we're on the Inc. 5000. Even if you're at Inc. 4,995 on that list, you're still going to get those. So it's a great hack, a great shortcut for you to actually come in and to attract venture capitalists. Now, Bizarre says, if I purchase a program, can I write it off at the end of the year? Yep, absolutely. Working with us, you absolutely can use the investment with us as a tax reduction. Hello from Michigan. Thanks for coming in, Quentin. I appreciate it. And what's the cost again? I think you guys are going back and forth. Credit Suite. Somebody from Credit Suite is in my chat right now giving the price. You can go to creditsuite.com/pricing to see our different options. It depends on what you're looking for. So back to fundability. We come back to fundability because we got to get back to business credit. If you're going to sell your business, if you're going to raise capital for your business, you really need to improve your fundability. And that also means you need to focus on your business credit. Remember, your business credit is the reputation that you have. It's publicly accessible. Anybody that wants your business credit reports can see them. So you need to make sure you build your business credit to attract the right kind of venture capitalists and angel investors. I'm going to give you two examples. First is from a show called The Profit. And again, if you're getting value here, do me a favor, hit the like button, hit the love button. Let's get as many people help as we can get. So there's a show called The Profit. Marcus Lemonis, I'm sure you've seen it. I love The Profit, as a lot of us entrepreneurs do. Marcus was vetting a company once, and this guy had this huge facility. He had like a sewing place in it, and a restaurant, and like basketball courts. And it was like everything, like an apparel shop, all in this one like mall type thing. And the guy had said some things to Marcus that just seemed sketchy. So Marcus went home that night and he pulled the company's business credit report. He came in the next day. He confronted the owner with things he found there that didn't add up, showing he was behind on bills, verified what he had found on the business credit report, and walked away from the deal. So this is a perfect example of a venture capitalist that has plenty of money in deep pockets coming in and saying no to a deal based on things that were uncovered from the business credit reports. Happens all the time. Now, second example is a lot of you might know Roland Frazier, and I handle the financing for all Roland students, Epic students. He teaches people, probably one of the biggest in the space of buying businesses, and I handle all the financing for those people. And what I do when I get into group settings, they invite me into large rooms, and I teach these rooms things like how to access business credit reports on companies you want to buy or invest in. So that's what I teach them. I'm teaching literally thousands and thousands and thousands of investors all around the country how to access your business credit report, okay, to be able to vet whether they should invest or buy in your business, whether they want to submit an offer to buy your business or they want to actually invest in your business. It happens all the time. Okay, it happens to me too. Today, literally this morning, I had my very first meeting was with somebody that we are looking to acquire. And I said, hey, want to talk about actually investing, being part ownership, or completely acquiring the business and getting that conversation started down the road. So I do this myself. I have thousands of investors do the same thing. So what I'm saying is that your business credit is very important because investors, potential acquirers of your company, venture capital, angel investors, they're going to look at your business credit report for credibility. So you really want to make sure that you're building your business credit profile and score out so your business looks like it's fundable. Now, you also want to make sure you don't have a name that indicates you're in a high-risk industry but your name doesn't indicate that you're in an industry that you're not. And you also really need to make sure, this is probably one of the most important things when it comes to equity investment, is you need to get your NAICS code right. Because in this world of angel investing, venture capitalists exiting a business, what industry you're in makes a really big difference. This is what we call multiples. And a multiple is how much of your profit, for example, your business is worth. So let's say that, I'm just making stuff up. Let's say that a software company is worth a 5 times multiple. That means if my profit is $100,000 a year and they're going off my profit, they give me a 5 times multiple of my profit, then that means I'm at 5 times 100,000. So my business is worth 500,000. But here's what's interesting. Financial services is a 10 times multiple. So if my company's financial services and not software, then that same company's worth $1 million, not $500,000. So I'm telling you, like, the industry you're in is all the difference in how much money you may get. Now, why am I telling you this? Because look at Credit Suite, for example. Are we an education company? Are we a software company? Are we a financial services company? We could be classified as any of those three. So we have to be very smart on the one we choose, because financial services could get us a better multiple when we exit or bring in outside cash from investors. But it also makes us higher risk. So you want to do some research if you've got a few industries you could be in to figure out which one gets the best multiple. Is it software? Is it financial services? Is it education? In this example, which one of it is it? And choose the one that gives you the best chance of raising the most amount of money. Because if I say I'm in financial services versus education, it's a big difference between the type of investors I invest and how much money they'll give me in exchange for what ownership potential in my business. So you need to make sure you go to NAICScode.com, find the right industry code. And if you're in between 2 or 3, do a little bit of research. See which one of those industries is actually worth more money. And in doing so, what that's going to help you do is that's going to help you, and it's actually NAICS.com, that's actually going to help you get the most amount of money from venture capitalists, from angel investors. It's also going to help you get the most amount of money when you actually go to sell as well. So some things to keep in mind. Now, Make sure you have any necessary licensing in your business. Again, it goes a long way to showing lenders or credit issuers that you're actually legit and credible as well. Make sure you have a business address set up. Don't use a home address. Don't use a PO box or UPS address. Again, that makes you just look unestablished to angel investors and venture capitalists. That makes it look like you're not even real. Okay. And then again, you need to make sure that you're building business credit. Having an established business credit profile and score goes a long way. An angel investor, a venture capitalist, somebody's going to feel more confident investing in you if they already see that other people have already given you credit. So you want to start with vendor credit accounts. Make sure you build out your fundability. Make sure you come in and get initial business credit building accounts with places like Uline and Quill and Granger. Get them to report on your business credit reports. And in doing so, you help create this valuable asset that makes you more lendable. Plus, you can continue to build your business credit. You can get credit at almost every major retailer: Visa card, MasterCard, auto financing, fleet credit for fuel, maintenance, repair of vehicles, all without a personal guarantee, all without a personal credit check. So again, you move up to retail credit after you get these initial vendor accounts, and you have a handful of accounts on your business credit reports, and you move in and get fleet cards for fuel, repair, maintenance of vehicles when you have about 8 accounts on your business credit reports. Then you get Visa cards, MasterCards, auto financing when you have about 14 accounts on your business credit reports. And again, the nice thing is the more well-established your business credit is, the easier it is to track these potential venture capitalists, angel investors, or people that even acquire your business, even people that exit. So there's all types of way to get money, but today we really had a chance to explore equity investing, where you've got to make sure your business is set up as fundable as possible. You want to choose the right NEICS code. You want to focus on building business credit. It helps you get the most money. But then once you've done so, then you can come in, you can attract angel investors. Then you can come in and you can attract venture capitalists. Then you can go to crowdfunder and equity crowdfunding platforms. You can look at that as well. And don't forget that you can also tap into family member and friends, stocks, bonds, 401ks, IRAs, equipment, other assets they may have, and get money for your business that way, where you don't even have to from affiliated angels or affiliated angels from you, where you don't have to take on debt financing. So another options that we've talked about as well. And if we can help you along the way, let us know. We never charge you a fee to help you get financing. We work with every legitimate funding program, over 1,000 funding sources. We will graduate you from loans you can get now all the way up to SBA loans. And it never costs you a dime of money to work with us. Don't get me wrong. Lenders and credit issuers charge interest rates and fees, and we negotiate to get those down, but it never costs you any money to work with us directly. And if you'd like to get an idea of where your business credit stands, where your fundability stands, or how much money you get now, then give us a call. On a consultation call with us, we will do a fundability assessment to figure what's wrong with your fundability that doesn't make you look credible and help you fix that. We'll help you get business credit for your EIN that's not linked to your personal social without a personal guarantee and credit check. We'll talk to you about how to do that. We'll get your credit reports, go through those with you, and give you tips and tactics to build your business credit. And we'll do a funding assessment. We'll tell you all the money you can get right now from loans and credit lines. It all happens on a free consultation. 877-600-2487, 877-600-2487, info@creditsuite.com. You can also go to creditsuite.com/consult. And if you got value, do me a favor, hit the like button, hit the love button, smash the like and love button, even the share button. That tells the social platforms that I'm not selling anything. I'm delivering value, and helps us help more people because they show it to more people. Also, Tuesday and Thursday at 1, 11 o'clock on Wednesday, all Eastern time, we go live on Facebook, Credit Suite's Facebook page, Credit Suite's YouTube channel, and my own LinkedIn page, Ty Crandall. So make sure you follow us there, like and subscribe, so you're notified whenever we go live again in the future. And don't forget to check the top right of our page, creditsuite.com. Daily tips on Instagram, Facebook, and Twitter. Hundreds of training videos on YouTube that will teach you how to put together a pitch deck. Everything you need to know about angel investors, including where to find them, where to find venture capitalists, the biggest venture capital deals that have happened in the world. Those type of things that will help you even get more information on these topics. It's all at youtube.com/credit suite, or you can access that at the top right of our page. And our podcast is there as well, the Business Credit and Financing Show. We've got 500,000 downloads of our podcast, and that's where we bring experts in that teach you all aspects of starting and growing a business, not just the money side. I'm on there too about money, but there's a lot of experts that teach you how to exit for maximum value, how to do SEO, how to build Facebook from scratch, how to do your branding. All those experts come on that podcast and share as well. So that's another valuable resource that can help you along the way. Okay, so I'm going to go ahead and wrap this up. If you have anything else that we can help you, if you like that free consultation, get in touch with us at 877-600-2487, 877-600-2487. Don't forget to like and subscribe. And I look forward to seeing you on our next training where we talk about more cool ways to get money to start and grow